Well, needless to say, 9/11 was an extraordinary geopolitical, security, and personal tragedy for huge numbers of people. But what I was most fearful about in my responsibilities was that history had told us that that type of shock to an economy tends to unwind it. Because remember, economies are people meeting with each other. That is, it's the division of labor, it's the specialization of labor, the markets are running. What that did is it froze everyone in place. And you had nobody engaging in anything. And as one would have expected, the GDP fell sharply for about 6 weeks. And I was very much concerned that we were in the throes of something we had never seen before. But extraordinarily, it stabilized after 4 to 6 weeks. And in retrospect, it was very clear to me and to my colleagues at the time that the degree of flexibility in that the American economy had developed in the previous decade or so was such as to enable us to absorb a shock of that order of magnitude and dimension. But as you know, we were already in the throes of a recession at that particular point, and it was adding essentially additional negative fuel to the fires. So it was a worrisome period, and indeed we only gradually came out of it. Clearly, you cannot diffuse these things unless you hit them right on the head and break the economy, essentially break the potential profitability that is engendering that sort of stuff.
Is we have to find a way to simmer down the extent of activism that is currently going on and allow this economy to heal. That is a very minority view in this country. I will argue that we have to let the facts show what they do. And I'm not saying that the stimulus is not working. I'm just saying it's working far less than anyone anticipates. There are a certain number of people in the society which must be housed. They'll either be in rentals or they'll be in homes. And you can move things around all you want. You're not going to avoid that particular requirement. And what the data show is after a dramatic rise in home ownership, in which 100% of household formation went into owner-occupied homes, mainly single-family, which of course is the cause of the huge boom in construction. That stopped about 2005, 2006, and has since gone into reverse. So that we're actually losing the number of homeowners, and as a consequence, we're getting housing starts for single-family dwellings down to unbelievable levels. It's 500,000 annual rate, which is barely the amount of demolitions that go on in the country. I think that until we unload the very large amount of single-family homes for sale which are vacant, these are largely held by investors. And fortunately for us, there is no evidence that they're trying to unload these, because were they to do that, prices would be under real downward pressure. But they're not doing that, but nonetheless, there's this big overhang of unsold homes on the market. And until we absorb that, there's no real solution to the recovery. But the real estate owned by the financial institutions is horrendous. And that stuff still has to feed into the market. If prices can hold, and I'm not sure about that, I'd like to raise one problem that disturbs me more than anything else. In 2005 and 2006, there was about 8 million homes purchased with so-called conventional conforming mortgages, 20% down and the like. That's a very big chunk for the housing market. The home equity of that 20% down payment is now gone. Right. So we've got a lot of conventional financed homes, as you put it, sitting right on the edge of going underwater. Fortunately, they don't default very quickly, but if they get there long enough, as you know far better than I, they do.
Well, there are a lot of strategic defaults, as they call it, where people are
Right.
basically not paying their mortgage payments, and the lenders are not foreclosing on them because they don't want to take on the homes. They'd have to show the losses on their books, and they don't want to maintain the homes. And if you have a vacant home, the value of that home drops anywhere from 5 to 10% as soon as it's empty. But at some point, there's going to have to be some sort of moment of truth here, where you have literally several million homes in this.
Isn't it free rent?
Yeah, it's what enables them to pay down their credit card obligations, for example. And that's what's been going on. But sooner or later, there is going to be some movement on that issue. And that's one of the great vulnerabilities. The one thing, of course, that would save it would be an improvement in employment. I mean, in one sense, jobs really will help out the housing industry. And that's another area where we have seen a dramatic drop, and with virtually no response to the enormous fiscal and monetary stimulus. You can say we saved some of the jobs, but the fact is we're looking at the highest levels of unemployment and partial unemployment that we've seen really since the end of World War II. And those numbers do not seem to be getting better. So what is it that we can do, in a sense, to have that primary driver of both confidence and the ability to maintain homes and to enhance and support consumer spending? How does that change? And is it structural or is it just cyclical?
No, I think at the moment it's a little bit of both, but the critical problem here, if it's a problem, is that even as the economy was growing, employment wasn't, which is another way of saying that output per hour was increasing. But it's that very output per hour increases, the productivity increases, when you look in terms, as I mentioned before, about non-financial corporations. One of the issues here that's creating statistical concern on my part is we're getting this huge surge in corporate profits, which is the result, basically, of the improvement in productivity and the decline in unit costs. And that is not spilling over into new investment. Instead, it is showing up as a major increase in the size of liquid assets as a share of total assets in the corporate sector, the highest level in 50 years. It's essentially a reflection of the fact that the business community is extremely averse to risk of investing in long-term illiquid assets. And that is another way of saying that construction generally, as you know, is under severe contraction, basically because the higher the risk premium for long-term assets, the lower the market value of the properties. And so we're seeing that particular phenomenon basically crushing construction, and construction is the loss in construction is the largest contributor of unemployment. And if you look at the distribution of who's unemployed, what sticks out readily is the big construction worker component. And I don't think the answer to the employment issue is to slow productivity growth. It's slowing by itself, or almost normally. But the answer here is to get the economy going again, and the only way I can see we can get that is to lift this pall. Remember that we're getting all sorts of indications of what this pall is all about. For example, not only is there a contraction relative to cash flows in the issue of new fixed investment, but the nature of that investment is going increasingly to short-lived, less illiquid assets, in the sense that if you look at the ratio of equipment and software to total investment, it's going up straight away as structures haven't even turned. There's been a significant rise in capital investment in equipment and software, but in total, it's nowhere near the rise required to absorb the amount of lost investment. I'm estimating the loss at something like $400 billion, which is not a whole lot much different than some of the estimates.
We were building 1,600,000 units of housing. We're now building somewhere on the order of 400,000 to 500,000. Roughly 1 million homes are not being built. The employment per home was generally anywhere from 5 to 10 people working on a home. Those jobs are simply not coming back for a good while, given what's happened to housing prices. Now, that is a huge lump of unemployment that we're going to have a great deal of difficulty addressing. How does the government respond to that?
Well, my argument at this particular stage is we'd probably be better off by doing less than more. There's an implicit judgment on the part of most economists that in order to stimulate the economy, you have to do something. But I think there's another choice here, which is basically gets to that old business of when you're digging a hole, sometimes you stop digging. And my view here is that I think we'd be far better off to allow the normal market forces to operate here, because one of the things that we have going for us is that the equity premium in the financial markets is at the highest level, according to J.P. Morgan, in a half a century. In fact, it's tracking these relationships that I've mentioned before about investment and savings. You see the process of everything is 50 years, the worst in 50 years at least. If you look at the study that just came out yesterday by the National Association of Independent Businessmen, which is the small business people, their capital investment is the lowest in the history of the survey, which goes back 35 years. We've got to get that coming back, and to the extent that the evidence suggests that very large deficits do concurrently crowd out capital investment, there is a debit to the stimulus program, which is probably somewhere between a third and a half of what the gross stimulus is. And that's where the problem is, and we've got to remove that. And I would say that because we have such a high equity premium, the upside of equity prices rising is very significant. And as I've written and said for a couple of years now, the most effective fiscal stimulus we could get, or stimulus, would be if the market value of equities rose. It does remarkable things to financial institutions, and it is a very clear indicator of the impact of asset price changes on capital investment.
Well, we had a considerable increase in equities, at least in capital stocks, stock market prices. We have not had that in the housing market. And what you're suggesting, if I understand it correctly, is to be very cautious about further fiscal stimulus. I don't know why this brings to mind the definition of a bartender who is a pharmacist with a limited inventory. I mean, we really have very few options, in a sense, at this stage of the game, given what we've been through, both in fiscal policy and monetary policy, and that impulse to do something, your suggestion, could be counterproductive.
I think that what we have to do is keep an open mind on what the facts show. I mean, this is a highly politicized, sensitive issue. I mean, for example, I've been strongly in favor of closing the deficit as quickly as we can, because I think deficit problem is a much more dangerous issue. I don't think we have time to wait. So I'm coming out in favor, for the first time in my memory, of raising taxes. And the reason I'm doing that is essentially that I think that we're getting to the point at this stage that unless we come to grips with the deficit problem very quickly, that we're fooling ourselves about how much time we have. And I would love to see taxes go down, and I would hope that what we could do is, if we allow the tax cuts, the so-called Bush tax cuts, all to lapse, as they will, of course, legally on December the 31st, and then gradually bring the level of expenditures down, which is it's not a question of affordability, it's that we are committing more in the way of real resources in the public sector than we have. And unless we start to do that and then bring taxes down, or the way I put it, we should not have tax cuts with borrowed money, but we should have tax cuts. And the more, as far as I'm concerned, the better, but only in the context of bringing the deficit down, because unless we do that, I think we have very grave problems ahead. And none of the issues we're discussing this morning will get solved.
There's a widespread feeling in the business community of a lack of confidence in this administration. It really does have an effect on the decision-making process. In part, I guess, because the economic consequences of the fiscal stimulus and the monetary stimulus have been so limited. There is a sense that these issues get politicized. What would you recommend, just on the intangible level of confidence? How would you suggest an administration sort of rebuild that confidence in the business community?
Well, I think that this president can do that. I think it's very clearly highly intelligent, as best I can judge, and he understands issues. And I think that politically, obviously, it's very difficult for him to turn. But I think it's feasible. In fact, I think...
Martin Wolf, a well-known economics writer for the Financial Times, described the last stimulus program as basically being too small, too wasteful, and too ill-focused. So that a lot of that stimulus was not stimulating. And frankly, I think there were so many different programs put into that package, transfer payments, alternative minimum tax, things that really were not directly, specifically increasing employment. If you had a stimulus program, in a sense, almost as a political, part of a package that would be political, what kind of stimulus program would you recommend?
Long-term infrastructure assets, because under current conditions, those are precisely the types of things which the free markets will not give you, because the discount rates are much too high and will remain much too high so long as there is a sense of malaise out there. So government stimulus, if it were put into the longer-term infrastructure assets, would not be displacing the private sector so much, because they're already displaced in that regard. There's no direct evidence that says that ever-increasing share of the gross domestic product going to finance is a necessary condition for increasing standards of living. And the reason basically is that this trend did not exist prior to World War II. And so there's something odd here that it requires explanation. But there is a risk out there that if you allow rates to rise as much as they are going to rise automatically on tax rates on December the 31st, that there are risks. But our choice is not between good and bad, it's between terrible and worse. And the issue here is we have to recognize that we cannot take the risks. I just don't visualize how we're going to get through next February's budget program, because there's no question that anybody who's looked at the data closely, as Pete I know has, is very, very great detail. We have essentially put on the books a level of commitment to the real resources of this economy, which I don't think we physically can meet. I'm not talking about financially, forget finance. And it's fundamentally that we do not know and we cannot forecast what the size of Medicare is going to be. And it's one of the reasons is that the technology is so extraordinary and improving so rapidly that when you put that into a fee-for-service, subsidized type of economic structure, it means that demand will get fulfilled irrespective of what it is. And if you end up with X percent of the GDP as medical expenditures, I guarantee you will find that X percent of total employment will be in the medical profession, and that means less to produce cars, less to produce agricultural products, less education, less everything else. It's real resources. You don't have to get to finance. It's just a question that we have, in this country, we are at the cutting edge of productivity growth. That means we cannot increase output per hour at a rate over a protracted period by more than 3%. At least that's what the data show. Since we know what the size of our labor force is, we know in general what the outer limits of the real resources of our productive system is capable of turning out. All I say is if you look at those comparisons, we're running out of resources, and it is reflecting itself in a gradual reduction in the cushion between the public debt held, I should say, federal debt held by the public as a share of the ultimate capacity to borrow. That is closing. It has never closed at this rate previously. The last time we were even close to it was during World War II, but then we knew that when the war ended, the demand for the military would collapse, that the deficit would disappear, and that we needn't worry about the longer term. And that's indeed exactly what happened. That's not the case today. And unless we come to grips with this issue quite soon, and Pete has devoted a huge amount of his time and resources to focusing on this issue, and I think that it's one of the few investments in this country which I think which may be working at this stage.
Yes,
Hi, Chairman Greenspan. David Malpass with Encima Global. The yen has been strengthening, and it's gaining momentum. The Chinese are buying JGBs, for example. Does that create a problem because Japan's economy is not very productive user of that capital? So it seems like that's creating yet another pool of idle capital. So what would you recommend to Japan, and could intervention be useful at this point? They're discussing it.
I know they are, and I think that they stopped intervening, I think, was it in 2004? And I remember when they stopped intervening, they were purchasing something like 50, the number was a small number, it was very large at the time, like $50 million a month or something like that. Well, in any event, there was a concern about what would happen when they stopped. And when they stopped, nothing happened. And the reason is that there is a global market that arbitrages out there, so that I think intervention never works unless you are an intervener, as I was for a while. The way we used to intervene was to wait until a particular currency was net short. Then we'd go in and we'd look very smart. But it was never a permanent sort of issue. Japan is a very different issue, because remember that the reason the yen is as strong as it is, the reason why you can sell JGBs for 10 years under 1% is that there is this extraordinary yen bias in Japan, where, as you know, nobody holds JGBs outside of Japan except in index funds. And the reason essentially is that the demand for yen issues domestically by Japanese is so strong that it keeps the interest rates low, it keeps the exchange rate strong, but I don't think it has a very significant international effect, largely because there is still heavy heavy arbitrage going on between all the currencies, and there is a Japanese problem. And the Japanese problem that's going to emerge is not there yet, which is essentially when the population ages sufficiently such that their consumption rises relative to savings, and eventually their current account surpluses turn negative. At that point, they're going to start to have to borrow in international markets at very much higher rates. That's where the real problem, I think, of the Japanese fund problems exist. And we're not there yet. We still got a way to go. But it's something which you ought to be wary of because it's going to happen.
Alan, we're at the end of the session. I want to ask you one last question, which is, we've had the most stimulative fiscal and monetary policy to try and address the downturn in the economy, perhaps since the end of World War II. It has had much less of an effect on the performance of the economy than almost anybody expected. We had a relatively small decline in output, but a much larger decline in employment. There is at this stage of the game, no sense of any momentum in the economy, really. What could we have done different? What went wrong? What lesson do we get from this really unhappy experience? The government predicted we would stop the unemployment rate at 8%. We're way, way above that. I could go on and on.
Well, first of all, let me just say that as one of the things I discussed in this Brookings paper is that central bankers for the last decade or so have been aware of the possibility of the type of crisis which eventually happened. We hadn't a clue when it might happen, but that it was theoretically possible was there. And as I pointed out in that piece, and as I wrote, as I made a speech actually a decade ago, when that happens, you find that there is no alternative but to substitute sovereign credit for private credit to keep the financial system and intermediation going, which is a necessary condition to keep the economy going. So I was very strongly in favor of, quote, the bailout, because I think the TARP actually was very effective in maintaining a degree of intermediation which we would not have had. And the Fed supporting the commercial paper market and money market mutual funds, these were all crucial actions to stabilize what is essentially once in 100-year, as I put it, once in 100-year flood. And you have to do that, and I think it worked, and I think it was very useful. I think to extend beyond that is certainly, in retrospect, not been very useful. If we were going to, because there was a general agreement with the Japanese and the Europeans to intervene, we would essentially wait until we sensed that the dollar was short. And we know that if you hit a short position, you'll unwind it very quickly. And we looked very smart. Like, intervention is effective, but we recognized after a while that it wasn't, and that's the reason why intervention stopped. This wasn't a U.S. issue. This was a global issue. Were the Germans to go back to the Deutschmark, there was a huge capital gain involved in the issue of repaying euro liabilities in what will then be a superior currency. Whereas if you take the southern currencies, there's a very large potential capital loss. You cannot run a system like that and expect it to hold together unless there is a continuous unilateral flow of aid coming from one part of the system to the other, which I think politically is infeasible. Politically, we're not seeing that.
And I'm sure that Chairman Bernanke and Greenspan would agree with this, that it is not an accident that we in the United States and in other countries as well, since then, have had essentially 30 years of something pretty damn close to price stability. And the dividends of that for our people and for our societies, despite the problems of the last couple of years, I think have far outweighed the short run and substantial costs that were incurred to get from point A to point B.
So it wasn't as though I was coming in cold. But when you're at a new institution, having just gone through a one-person seminar by that extraordinary staff on every subject under the sun, 103% of which I did not have a clue about, I had expected many subsequent disruptions to the financial markets because it's extremely rare to get a crisis of that type in which a speculative market, whether it's on silver or whether or not it's stocks or anything else, you're looking at a situation in which you get the first shot down, you get tendencies to recover, but usually there are second and third testings of the market. And one could describe it as a bubble because the run-up in stock prices in the summer of that year was really quite extraordinary. But granted it was a bubble, it had no footprint on the GDP that I could find even to this day. And we ran into the same thing in the dot-com boom. And the dot-com boom had many of the characteristics of what happened in 1987. And again, you cannot tell that there was any significant financial problem. Then we ran into 2007 and 2008, and it was a wholly different ballgame.
There's a sense out there that, quote, quantitative easing or asset purchases is some completely foreign, new, unstrange kind of thing, and we have no idea what the hell's going to happen, and, it's just an unanticipated, unpredictable policy. Quite the contrary, this is just monetary policy. Monetary policy involves the swapping of assets, essentially, the acquisition of treasuries and swapping those for other kinds of assets. And similarly, the way federal funds rate management essentially is aimed at reducing medium and longer term interest rates and raising asset prices, quantitative easing has exactly the same objectives. And so it'll work or not work in much the same way that monetary policy, ordinary, more conventional, familiar monetary policy works. So there is not really, in my mind, as much of a discontinuity as people think. Monetary policy is monetary policy. It's just that the specific tools that are used to create more easier, more supportive financial conditions are somewhat different. Just one comment that all of these points lead to, which is that there's a difference between an equity bubble and a credit bubble. An equity bubble, particularly if it's an unlevered bubble, there's a loss of wealth, and unless it's a huge bubble, like perhaps the Japanese case, it's going to be absorbable by the system, as we saw in '87 and the relatively mild recession in 2001. If it's a credit bubble, which is highly levered and leads to loss of capital and loss of capacity to intermediate new credit, then the damage is much, much greater. Now, what that suggests is that all of this talk about the Greenspan put, or the Greenspan-Bernanke put, or whatever, which thinks implicitly about the stock market, is more or less beside the point. I mean, the real issue is what can we do to just keep our financial intermediation system strong. And the position I've maintained throughout is that the first line of defense, at least, should be capital, supervision, liquidity, and other restrictions to make the intermediation system as strong as possible. So I agree with Chairman Greenspan about that.
I think the wisdom that's in the Bagehot, Minsky, Kindleberger, Eichengreen, Ackleroth, Schiller, many, many others actually runs way ahead of those who mostly bring negative attitude about economics, and I think that we'd make a serious mistake if we threw the baby out with the bathwater here.
I'm going to come back to babies and bathwater in a few moments, but let's just push this a bit further, because you came very close, it seemed to me, to saying that modern academic economics, as taught in graduate schools, along with a vast part of the research work that goes with it, was, as it were, an organized and systematic system. I'm not saying a conspiracy, but a systematic system for forgetting what economists actually knew.
And it is my impression that it would be quite easy to graduate with a PhD in economics from many prominent economics departments in this country with only the vaguest notion of what the liquidity trap is, while at the same time being familiar with a substantial amount of subtlety surrounding dynamic stochastic general equilibrium. And that latter subtlety did not inform our policymaking process, and having read the policy prescriptions of those attached to dynamic stochastic general equilibrium, I'm not led to think that the world would have been in a better place had their laissez-faire type recommendations been pursued.
I remember that I think one very, very famous Nobel Prize laureate in macroeconomics said that one of his great achievements was to eliminate the name of Keynes from all textbooks on macroeconomics. Obviously, you don't share this view. But let's just push a little bit further on what's going on. I mean, did this happen in your view because economists at the top of the profession were seduced by the idea of elegance, formal elegance, and completeness of the theoretical model, or was actually something more deeply ideological at work? Political ideology at work? What was the sociology, if you like? What was driving this?
And there are many different ways to interpret this, but there has been a market outside the academic world in large scale for those who have been involved in developing these various modes of financial thinking. There has not been a comparable market for those who have been developing some of the newer ideas in, for example, the new classical macroeconomics. And that says something about their practicality, perhaps.
I'm going to be provocative again. So let's one of the points
I've learned over time, Martin, that trying to be provocative can be problematic, but go right ahead. Better you be provocative than that you get me to be provocative.
But the difference is that it's my profession. Anyway, the question I had is, you said, which I think is very powerful, we understand bits of this system, but we don't really understand very well, and we don't know how to control the whole financial system as a whole. We know, we've had a very long experience of that, and we've been reminded of this over the last 30 years, that when the financial system goes wrong, very large crises can ensue. Very costly ones. You rightly observed that by those standards, the US economic crisis, by the standards of the last few years, is even relatively mild. But by some estimates, there have been something like 125 banking crises, and some of them have cost, just in fiscal costs, 50% of GDP. That's going to be the Irish figures, leaving aside the macroeconomics. Wouldn't a reasonable non-economist conclude from that? One, here we have this fantastically dangerous engine which you don't fully understand. Therefore, the obvious conclusion is you just cannot risk deregulating it. It has to be under government control very tightly all the time. How would you tell a layperson that that's not a reasonable response?
Well, in some ways it probably is. In some ways it probably is a reasonable response. And you know, the last time, this is an overstatement, but this was why Harry Dexter White was a communist. This was why there were a very large number of thoughtful people who were communists in the 1930s, because they looked and they saw that just letting the market rip had ended in disaster, and they convinced themselves that having not just the financial system, but the processes of production be controlled and planned as they were in the Soviet Union, that had not suffered a similar unemployment problem would produce a better outcome. And that did not prove to be conspicuously successful. So I think the question one has to ask is, there are going to be decisions that are going to be made by people, and the people are going to have incentives, and they're going to follow their incentives, and you want to get an outcome that is stable. And you have to ask what's meant by saying that you're going to have the financial system completely regulated and controlled by government. In some sense, we had that system in the Soviet Union, and it collapsed. We had that system with respect to exchange rates in the 1950s and 1960s. You know, we didn't move away from the Bretton Woods system because a bunch of economists got in a room and convinced everybody that fixed exchange rates were a bad idea, capital mobility was a good idea, and so we needed to shift monetary systems from a system that was working well. We shifted from the Bretton Woods system because the Bretton Woods system collapsed, because the internal contradictions within it, even as people tried to paper it over, didn't work. And so the question about more dirigiste approaches is, what exactly is the dirigiste approach and how will it work? Now, if you ask in general, has the world had too much leverage or has the world had too little leverage? I think the case is overwhelming that it has had too much. I think the case is overwhelming that it has had too much leverage, that the externality associated with taking on increased leverage has been under-internalized, that capital requirements in various ways should be systematically increased. There are a lot of ways to lend money in a modern economy with integrated production, and so controlling leverage is a complicated thing, and it takes a lot of thought as to how best to do it. But it is absolutely right, and every time I've spoken to a financial audience for the last 2 years, I've gone through some version of saying that we had the 1987 stock market crash, the S&L crisis, the commercial real estate crisis, Mexico, Asia, Russia, LTCM, the internet bubble, Enron, and now this. One crisis every 3 years from a system that is supposed to minimize, diversify, and spread risk has in fact been a source of risk that's led hundreds of thousands of people each time to lose jobs through no fault of their own. So I think it's absolutely right to be deeply worried about the outcomes that are produced. I think it is less right to assume that anger and dissatisfaction with the financial system constitutes a policy or provides a very clear blueprint as to the directions and the ways in which it is best reformed to promote stability. For my money, the best judgments that we have right now, and obviously there are ways it could be improved, are those embodied in Dodd-Frank. If you are big enough and systemic enough that your failure is a major event, you are big enough and systemic enough that it should be one institution that's competent with technical things, job to regulate you. There needs to be procedures for resolving and managing the failure of any kind of financial institution, not simply banks. There needs to be a systematic and across-the-board effort to make levels of leverage lower and levels of capital higher so as to make the system safe for the greed and cupidity that will eventually happen. I think these kinds of principles we know, but if you say the financial institutions with which the U.S. government was most heavily involved were Fannie Mae and Freddie Mac, which arguably were the site of the greatest degree of irresponsibility. It was commonly argued in the 1960s and 1970s that a great thing about socialism and communism was that if the government ran the factories, then the externality about pollution would be completely internalized. And that if you just could have the government run the factories, then the externality would be well managed and you'd avoid having the kind of degradation that you had when people ran them purely for profit. That didn't prove to be a good theory of public ownership. And so I think one has to think very hard about alternatives. And I think the type of approaches that the world's groping towards, while very imperfect, are in the right direction.
Just one final question in this area. We've had a debate in our pages which has very much interested me between Alan Greenspan and Barney Frank. And Alan Greenspan has said it's a complete waste of time because regulation will always fail. And Barney Frank says, responded by saying, well, do you really think after this crisis you could do nothing? And it seemed to me Barney Frank has a pretty powerful argument. But let me just follow.
See, I agree with you. I mean, I agree with you, and that's why I talked about the particular steps.
But let's
that
follow
I just
up
talked
this
about.
specific. Let us imagine. Just think, we've had this huge bill, the Dodd-Frank Act, I suppose. We've had Basel and all the rest of it. Let us suppose, in the current very concentrated financial system, we had a wave, and they usually get into problems at the same time. We know that's one of the features of the system. Wouldn't you, in fact, in this country and all the other countries, have to rescue all the big financial institutions again, and that we're basically in the same trap as we were before? Do you feel confident that that structure of too big to fail and everything going with it is actually in any deep way changed?
I don't think any country, any modern industrialized country, is likely to allow the complete implosion of its financial system. I don't think that's ever likely. I don't think you're ever going to see that. I don't think that's got anything much to do with whether you have a lot of big banks or you have a larger number of small banks, each doing what the big banks were. I don't think that's fundamentally about whether you have banks or whether you have money market mutual funds, or whether you have lending taking place through the capital markets and you have potential collapses. So I think that there is a sense in which misrun institutions need to be punished, will be punished, are better able to be punished after this. Once every 50-year disasters, I think, are likely to be met with policy, I hope, will be met with policy responses. The heyday of the line of thought you're advocating was the heyday of the line of thought that is implicit in your question was the 20 hours surrounding Lehman's demise. And it didn't work very well. Lehman, to remind, was less than 2% of the US financial system, would not have been too big to fail on anybody's theory of too big to fail, and didn't violate any of the scope restrictions that anybody has suggested. So I think we do have to reckon with the fact that there are these systematic connections that we will need to address very hard. Questions about monetary policy and the formation of bubbles, questions of exploring multiple instruments that address levels of interest rates and levels of leverage. But it is no more realistic for governments to say that in the presence of systemic failure, financial failure, they're not going to take extraordinary steps than it is to say that in the presence of kidnapping, they're never ever going to pay ransom.
In fact, that we had enormous success and have had enormous success in the world economy over the last 10, 15 years, particularly in developing countries. Has the financial markets played an important role in this? To what do you attribute that? And is there a danger as we reform that we lose some of this? That's my understanding of this question.
I think there are two parts to that question. I'm probably more sympathetic to financial innovation than the average person in this room. But I would not want to make the argument that financial innovation has been an important financial innovation in terms of derivatives and in terms of the development of all of that has been an important contributor to China and India's success. I think there's a different question, which may have been what the very thoughtful questioner had in mind, which is to what extent did the managed export-oriented exchange rate contribute to enjoying a period of remarkable growth, and whether international monetary reform that in the name of symmetry reduced the ability of developing countries to, at an early stage of the convergence process, use a depressed real exchange rate as a tool of industrialization, be in some way problematic. And I think that is a very fair and legitimate question. I think you do need to recognize that it is going to be harder for countries with over 1 billion people to operate on that basis as they enter their third decade of 10% growth than it may have been for Europe or Japan to operate on that basis in the 1950s and 1960s, just given the political imperatives in the industrialized world. But I think it's a very real and legitimate issue that does need to be considered. My own suspicion is that there may turn out over the intermediate run to be a little less in this whole debate than many people think, because I think China is reaping the consequence of its exchange rate management in terms of higher inflation rather more rapidly than many people would have expected a year ago, and therefore is finding itself with less ability to control its real exchange rate than many might have expected some time ago. But I think it's a very legitimate issue.
On the training point?
I think there's a very fine sort of judgment that teachers always have to make, which is to what extent they teach students what they're interested in and what they find most exciting and what they experience as the cutting edge of their research, and to what extent they need to present a broad range of perspectives to students. And for my taste, PhD instruction in economics is a bit tilted towards the former at the expense of the latter. And that's why a lot of stuff that I was taught when I was in graduate school and that I found enormously useful over the last several years has passed out of the curriculum. And I think with some real cost. But I'm also sort of aware that when I was 30, I didn't have all that much time for what the old guys thought the new generation of students needed to learn, and now I'm one of the old guys, so I sort of have some hesitation about pushing my views with excessive vigor.
This is uncharacteristic modesty.
Maturity, we call it.
Yes, I know the feeling. It happens when you hit 60.
I find the idea of expansionary fiscal contraction in the context of the world in which we now live to be every bit as oxymoronic as it sounds. And I think the consequences are likely to be very serious for the countries involved. I think it's important, as you did, Martin, to distinguish between people who aren't borrowing because they can't borrow, where there is a question as to how large a subsidy they should be given from the outside when they have worked themselves into a situation where they're no longer able to borrow. That involves one set of issues. A different set of issues are raised by those with very limited scope to expand monetary policy, with the capacity to borrow, who choose not to borrow based on the conviction that the improved fiscal hygiene will make everyone feel so much better that the economy will recover, which seems to me to be a very high-order gamble indeed, and not one that I would be prepared to bet on. But I've always been a believer in being an empiricist about my convictions, and so I would be happy to say that if Britain enjoys a boom over the next 2 years, coming from increased confidence, I will be required to quite radically rethink my view as to how the macroeconomy operates, and to be quite contrite about the seriousness of the misjudgments that I'm making. And you can make a judgment, those of you who know me, how likely I would be to, how big a risk I would take of putting myself in a position of great contrition. And you might therefore conclude that I'm fairly confident this experiment is not going to work out well.